Hey everyone, welcome back to Corporate Decoder. Today we're diving into some SEC filings, and trust me, it's going to be more exciting than reading the phone book, or maybe just slightly. We are going to dissect a recent filing from Blackstone Secured Lending Fund, ticker BXSL. It's packed with information, so let's get to it. The filing gives investors a peek under the hood, and while it might seem like a bunch of boring numbers and legal jargon, it's our job to make sense of it. We are going to find the interesting details that tell a story. If you appreciate getting straight insights from corporate documents, don't forget to subscribe to Corporate Decoder. We also have a Discord community linked in the description below where you can discuss these topics with other investors. First, this is a pretty standard filing. Blackstone Secured Lending Fund filed it with the Securities and Exchange Commission, or SEC, as recently as July 11, 2025. This shows that everything that it mentions is as of the summer of 2025 and gives the latest data on this company. It's a Form N2, which is a registration statement for certain investment companies. What this all means that they will be continuing to sell all sorts of shares. Blackstone Secured Lending Fund, or BXSL as we can call them, says that they want to invest primarily in loans and other securities such as private companies in the United States that include larger and middle-sized companies. They generate income and have some long-term capital appreciation. They are also a business development company, or BDC, which means that they are subject to certain rules and regulations under the Investment Company Act of 1940, or as the document calls it, the 1940 Act. BXSL want to qualify each year as a regulated investment company, or RIS, under something called the Internal Revenue Code. This gives them some tax advantages, as we will see. The fund looks at the advisor Blackstone to source and evaluate transactions, using a defensive approach and focusing on loans and securities of private US companies. All of this is to the goal of making good income and capital appreciation. They do say that there are some risks here due to the use of leverage or debt and other factors. They also say that shares of BDCs can trade at a discount to their net asset values. The Blackstone part of this shows up by way of what are called advisors who make the investments and manage the process of making even more money. These are Blackstone Private Credit Strategies LLC and Blackstone Credit BDC Advisors LLC. They are affiliates of Blackstone, which basically means they are owned by the same parent company. These have access to Blackstone Credit Resources. Blackstone Alternative Credit Advisors LP does a lot of accounting and that sort of administration. They mentioned that Blackstone itself has over $1 trillion in assets under management, and Blackstone Credit has over $300 billion. These are enormous numbers. Blackstone believes that it offers benefits such as the ability to provide different kinds of financing, a strong team of experts, and what they call the Blackstone Credit and Insurance Value Creation Program. Basically, it is the ability of Blackstone to also help the investment and provide support to make even more money. They have a way of lowering costs and increasing value. The firm actively tries to find investment opportunities called origination and performs due diligence to find out how good they really are. They then actively manage these investments. This all tries to maximize income and minimize risk. So how do they figure out how much all of this is worth once this is in their portfolio? The Board of Trustees has to put a fair value on each investment by looking at what the advisors say, as well as independent valuation firms and other service providers. This valuation process matters quite a bit. How much does all this cost? That's the most important thing. The fees and expenses for the fund are listed in table form, and although it is boring, it is very vital to understanding how well you will do as an investor. That table shows the shareholder transaction expenses are none, the annual interest payments on borrowed funds are nearly 6%, other expenses at 0.5%. Total annual expense is 11%. This is the key number that comes up. All public BDCs have a high annual expense, and that is in line with what happens in private equity. To show what these fees would do over time, they provide an example. For a $1,000 investment with 5% annual return, you would pay percent annual return, you would pay $84 in the first year. After 10 years, you would pay over $700. The fees really add up. They are estimated, of course. To show what the fund has done recently, they also have financial highlights. How have they done? As of the end of March 2025, the net asset value was $27.89. On July 10, 25, the share price was almost $32, so this means it's trading above the market value. In terms of investment performance, total return based on MNAV was around 3%. Let's move to some risks. These are important to note as well, and they list risks related to their business and structure, their investments, the advisors, business development companies, company financing, and of course, federal income taxes. It is definitely high risk, so don't go all in, as they say in their risk section. Another thing is conflicts of interest that are possible with the advisors, so keep a lookout for those. Of course, a big segment is about making assumptions and predictions. These could be inaccurate, and so they say not to rely on forward-looking statements. The price range of common shares is interesting, as you see how well this fund has been doing in the past. The good news is it usually traded above net asset value. Of course, no guarantee that it will remain that way, but it has done so in the past. Management talks about how the board is doing. This is where they have data about how the board is structured and how it performs. The portfolio managers are listed and some of their backgrounds, such as Brad Marshall and Teddy Deslodge. There are also the members of the investment committee who have to give their approval for investments. To close out, there is additional information such as foreign currency transactions and other things we would call legal fine prints. So there you have it. That's the recent SEC filing, which is a jumble of interesting and boring stuff. The Blackstone name is very big here by using that brand. They claim to be able to help the fund make even more money than it otherwise would. Of course, we should remember the risks, including the debt and those management fees. Blackstone have been building business for 35 years. This scale allows them the benefit. It looks like the value has been going down at almost 10% annually. However, we see above that there are PI interests and other things that make up these calculations. Alright, that's our breakdown of Blackstone Secured Lending Fund's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.